Perfect. Thanks, Joe.
Right, well, good morning, everybody. My name is Jo Tomlinson, and I'm going to be talking to you today about accessing funds during COVID-19, but also accessing funds generally, because obviously we're not going to be under this cloud forever. Thank goodness, everyone says. So who am I? I am an accountant, a qualified accountant, have been for 30 years. I did 20 years in industry before I started my own accounting practice, which was 12 years ago now. I mostly, when I was working in industry, worked in manufacturing industry, mostly food, mostly chocolate. But that was because I really like chocolate, and you often get factory shops wherever you work. And if you get a bit of discounted chocolate or biscuits, then why not? The fish fingers and peas were good at Birdseye as well, actually, when I worked over in Hull. So yeah, I've also had a couple of stints over in Hull in your region. I've worked for Birdseye over there, and also Willoughby, the caravan people. So I've worked for both of those organisations over the years. When I worked in industry, I was a commercial management accountant, which meant that I was taking information on the business and doing analytical work on it to help the senior managers in those organisations to make business decisions. So how do we make more profit? How do we save costs? What are we making profit on? Should we do this project? What will it look like? All that kind of thing. Also doing all of the budgets, the cash flow projections, forecasts, all of that kind of work. So I started then my own accounting practice, doing compliance work for a couple of hundred businesses. I've got a team of 10 out in Garforth, and also do some of this kind of work for those people too. And as you can imagine, with 200 small business clients, they sometimes need to get access to finance, often because of growth aspiration, and growth leads to the need for cash. But at the moment, obviously, we've got this specific circumstance that is unprecedented, but it's leading to a recession situation. And in a recession, things become that much harder. So all of the things that were already hard in business become even more difficult during a recession situation. And the biggest pressure that you tend to see in a recession situation is that on cash. So if that is the situation that you are finding yourself in, either through a decline in customers or increasing costs as a percentage of what you're bringing in, or whatever that might be, then how do you get access to funds to be able to still conduct the business that you are in, is what we're going to talk about today. So cash is king, obviously. It's king, the queen, and all of the courtiers, especially at the moment. So what's available to you? How much do you need? Because a lot of these accesses to finance routes are for loans, and loans need paying back, and they come at a cost. So it's not a case of just smash and grab, get anything that you can. It's a case of looking at, well, how much do you actually need? Getting in finance that you need, that you can afford the repayments on, and working out what information people might need for them to feel comfortable with giving you that amount of money for you to use in your business. So that's what we're going to cover today. So let's talk about the COVID support measures first, seeing as that is the situation that we're currently in. A lot of this, I'm really hoping that you guys already know about pretty much all of this, but just in case you don't, I don't want to make an assumption that then proves to be false, because these things are a real lifeline for businesses right now. So the business rates grant isn't repayable, it is taxable, but if you have business premises, depending on certain circumstances, you get money given from your local council. So £10,000 if you qualify for small business rates relief, and then up to £25,000 dependent on certain business sectors. But please speak to, if you haven't had your business rates grant by now, please speak to your council, So some councils were quicker than others. Leeds were telling me that they were a really big council. That's why they were slow. I'm not sure what they were like over in Hull, but we certainly have clients over in that area who received their money much quicker than the Leeds ones did. But if you haven't had your money already, speak to them at the council. You do get put on hold for a long time, but if there's £10,000 at the end of it, I would suggest it's worth your time doing that. The next thing is furlough. So furlough is if you've got any employees who are not able to work because of COVID-19 or are shielding, or even, you know, if they're ill, you can furlough them. So just excuse my dog scratching on the door there. My son will come down and sort her out in a minute, hopefully. So with the furlough grants, those opened up just over a month ago now, and were being paid in 6 days. So that's really good, a really good turnaround. There can be some complicated calculations that need to be made, especially if your workforce is variably paid. It's not so bad if they're fixed paid, but the actual process of applying is pretty simple and the money comes through really quickly. And again, that is a huge lifeline for businesses. And we've got this particular furlough scheme in place for at least the next 2 months. And then there is a suggestion that there will be a new version of the furlough scheme put into place, which will have potentially a part-time return to work option available, but also a funding from businesses to go towards the cost of this scheme. So 80% of people's pay, the suggestion is that 20% of that will be needed to be paid by the business and 60% will come through in the form of a grant. Again, when the grant comes through, that is taxable. So it needs coding in the right place in your accounts. It's meant to offset a cost, which is what it does, but it sits as taxable income. That's the way that it works in your accounts. So the next one is the Natalie titled self-employed scheme, basically. So self-employed income support scheme. And those grants are starting to be paid out now. The money's starting to go into the bank. And again, a really simple process to apply for this grant if you're self-employed, not a limited company. And this was based on the last 3 tax returns. Quite a simple process to work out how much you will get, and quite a simple process to go online and make the application for those monies. So lots of people have already had that money now, which is great. So the next one is top-up grants or local authority discretionary grant fund. This is quite new. So it was announced a few weeks ago and the money was given from central government to local government. And they basically have at their discretion up to £10,000 by and large to give to people based on need. So there is an application process for these grants. It's not like the business rates one that just as long as you qualified for small business rates relief, you get it. The point of this particular grant was that a lot of people who have got business overheads, premises related overheads, didn't get the business rates grant because they didn't pay rates. So they might be in shared offices, some of these easy in, easy out rental offices, and some small charities and small businesses who were in offices like that. They didn't qualify. So this is kind of for them, but it doesn't have to be only for them. It is at your local authority's discretion. So if you feel that you are in need of monies, they're kind of saying it needs to be premises related. But again, to me, give it a go. Why not? Then there's an application process that you need to go through. Not all of the councils have actually launched their portal yet to do the application, but it's worth checking on your local authority website or giving them a call and saying, what's going on with this grant fund? How do I apply? I'd much rather people apply for things and get knocked back than not apply and go under. You know, it's all about business protection at this point in time. So If that's something that you think you might qualify for and you need it, if you're in desperate need of that funding to keep you afloat, then please get in touch with your local council and see whether that's something that they can help you with. There are also a number of local grants around, so different organisations are putting together support packages. Obviously, James has spoken to you about the support package that the Humber Business Growth Hub has got, but there are other funds as well out there. So have a look in your local area and see what's available to you in your circumstances. We've got a client who's got a base in Scotland, and they've had a grant from a local grant fund for their business premises, etc. So have a look at that and see whether there's anything in there that might be applicable to you. And then loans. So the government also announced initially the coronavirus business interruption loan scheme. There was a small business and a large business version of that. And then I think that's Daniel that needs muting. So the small business version is what we'll talk about here, but then they followed it up with the bounce back loans. So I'll just talk to you about those two schemes. So the first one, the Sybil's, who's eligible? Well, turnover up to 45 million and a viable business, whatever that might mean. And a loan of up to 5 million, 80% guaranteed by the government, no guarantee fee for SMEs to pay, up to 6 years, but the borrower is always 100% liable for the debt. I think that's obvious to me anyway, that you are liable to the debt. Now, a lot of the banks, a lot of the institutions that were offering these loans, certainly early on, were looking for personal guarantees, and a lot of people weren't happy about giving personal guarantees. I think that changed after the first few weeks, that they were still looking for personal guarantees, and people were applying and being rejected, or applying for a Sybil's loan, but actually being sold a different loan. And the government said when they brought this particular product in that it was for people who didn't qualify for standard loans that were available in the marketplace. So that was totally legal for the banks to do that. And often those loans were at higher interest rates than these ones. So it would have been commercially daft of them to not, at the very least, try and get those products away, I guess, if not particularly ethical. So those were around first of all, and lots of people applied for those. I found it quite cumbersome. It's taken a few weeks for monies often to come in, depending on which bank you've used for those. But lots of people have had success in getting those now. Then the government came up with the bounce back loan, and the bounce back loan was smaller, so kind of aimed at much smaller businesses, I guess. And it was saying that you could get between £2,000 and £50,000, and it was based on turnover. 100% guaranteed, no fees or interest for 12 months, and only a 2.5% interest rate per annum after 12 months. Well, this is kind of too good to be true as far as loans go, because you do not get that kind of interest rate offered on the marketplace very often. That is at the very bottom end of a commercial loan, and typically would need to be with a AAA rated bank, and you would need to be whiter than white. You would probably need to not need any money for you to be able to borrow money at that kind of interest rate, in fairness. So it looks a little bit too good to be true. It's really easy to apply for. So you go online, you make your application. Certainly in the early stages, it was better to have a business bank account with the bank you were applying for it with, because they already had all of the anti-money laundering and everything in place. That was a really quick turnaround. People were getting money in their bank within hours, applying in the morning, getting it in the afternoon, applying for it on a Monday, getting it in the bank on a Tuesday. So lots of people have applied for this, lots of small businesses, and have been successful in doing so. My worry is that this is still a loan and it still needs paying back, and that affordability and viability check that there was with the Sybil's loans is not apparent here. So me as an accountant, obviously I'm risk averse. I want to protect businesses and make sure that they are viable on into the future. The worry for me with this is that it's not made clear enough, I don't think, that this is still a loan and it is still repayable. So you need to be able to afford to pay that back. So just a few statistics. As at the 24th of May, the percentage of people actually getting a Sybil's loan was about half of the ones that have applied have actually been given them. Whereas because the criteria for applying for a bounce back loan is much looser, 79% of people who apply for a bounce back loan are getting given it, but the amount of money that they're getting is also much lower. So on average, £30,000, whereas for the Sybil's ones, you know, people are applying for much more money. And typically that now is the decision that people are making. So they're saying, is £50,000 enough for me in my business for it to survive through the next weeks and months, however long it's going to be before my income starts coming in again? And if it's not enough, then people now are typically applying for a Sybil's loan. But because of how good the terms are for the bounce back loans, it is tending to be the first port of call that people are making. Go for the bounce back loan, but if it isn't enough, the bounce back loan, then look at the Sybil's loan. Tends to be the strategy that people are employing. So if you go for a Sybil's loan, or some of these discretionary grants, then you will be asked, how much do you need? And you might be asked to back up, how much do you need, as a question. So how much do you need? Well, you need to know that first off, because if the money is going to cost you money, so when there's interest applied to it, and sometimes, dependent on the loan product, there might be a setup fee, then if that's going to cost you money to get, then you need to make sure that that is something that's going to provide you with value for that money. So, you know, applying for a loan that you're just going to sit in the bank just in case is a very expensive just in case scenario. So having a look at your cash flow forecast and seeing how much you actually need is a really important thing to do, because you need to know how much you should be taking and how affordable it is to you and how long you need it for. There are lots of different finance products available to you, and knowing which one you need is key. And finding which one you need means you need to do a cash flow forecast, because you might only need it for 6 months, you might need it for 3 months, you might need it for 16 years. And you might need to dip in and out of it once every year because of the nature of your business and the seasonality of it. And all of that information dictates which the best loan product or funding option is for you in your business. So I would really urge you to have a look at your cash flow, remembering that cash is not profit and cash can often be lagged behind profit. You can have a really profitable business and have a profitable sale, but if somebody's not paying you for those goods or services for 30 or 60 days, then that's the timing that you should have in your cash flow analysis. And the same for costs going out. You know, you earn money that's taxable. The tax doesn't go out for 9 months after the year ends, or the VAT, it's, you know, five weeks after the end of your VAT quarter, whatever that might be. So you need to understand the timing of the cash going in and out. Pop that in. It doesn't have to be massively sophisticated or massively detailed. You could have that at a total sales and different kind of lumpy, I call them sometimes, lumpy costs. So you could have total office-based costs, total costs of sale, and just have that per month for your detail level. Timescale. Most people are going to want at the very least this year or a year. So if your this year finishes next month, that's probably not going to do them. They're probably going to want the whole of the next year as well. Depending on how much money it is and which product and who you're getting it from, sometimes they can want 3 years. But they do understand that your ability to predict your cash flows in 3 years' time is going to be less detailed, less accurate than it is when you're looking at what your cash flows are going to be for the remainder of this month and next month. So the further you go out in time scale, the more wet finger in the air guesswork goes on. It's an educated guess, but your accuracy level is bound to go down the further out on the timeline you go. Banks, financial institutions, accountants, and you really, scenario analysis should be really important to you. It's kind of the what if strategies. So if you look at, this is what I think my business will look like coming out of lockdown, coming out of COVID, coming out of this recession, look at it as like base business. And then if you were to say, and what happens if 20% of my business falls away because those businesses have fallen by the wayside? If you put a scenario in with that and you can still afford your repayments and that dictates the level of the loan that you're looking for, then that's a good thing to do. And also in the other direction, you know, what happens if we get this V-shaped recession bounce back that is like boom or bust, and we go from doom and gloom and there's nothing happening to all of a sudden we're falling over ourselves to sign new business? What does that look like as a scenario? Could that happen to you? And if it did, how many people would you need to employ? What would the premises look like? You know, that kind of scenario analysis. So it's worth kind of sitting in a darkened room and just really thinking outside the box and coming up with some scenarios for these things too, because they really are useful when you're looking at cash flow projections. So the next thing, what do you need to do it for? So why do you need the money? So a bank, a financial institution, typically are going to ask you what you're going to spend their money on. So you're asking somebody to fund something. What is that something? So again, they're not going to be happy if you say, oh, well, I just want 50 grand as a buffer. They want to know what you want it for. So it might be for normal business expenses. It might be for staff wages. It might be for rent or ongoing service provider costs. We've got all sorts of service provider costs that haven't been able to go away just because we've not been in our offices. We're all working from home. We've got an office. We've still got a mortgage on it. We've still got gas and electric. We've still got, well, we're not having the bins emptied, but there's still a flat rate cost associated with those. We still need IT support, even more now we're working from home, we need IT support. So we've got ongoing service provider costs that we still need to fulfill. And lots of businesses have that, even though they may have no business that they're doing from a sales perspective, they may have costs that they still need to meet in their business. And marketing, you know, to come out of this recession, to come out of this COVID lockdown situation, to let people know that you are back trading, that your premises are back open, that you're now, you've pivoted, you're doing a delivery set, whatever it might be, people need to know. Unless you tell people, then they're not going to buy from you. So marketing might be what you need the money for, because unless you come out of this with a marketing budget and the wherewithal to tell people that you're now trading again, or that you're trading in a slightly different way, then how will they know? And they're not going to buy from you. So it might be that what you need is funding for a marketing budget to propel you out of this lockdown situation. Or you might have creditors. You might have people who provided goods and services to you prior to this lockdown that you had no worry about paying because you had an ongoing trading business that was really viable, and then suddenly that fell off a cliff. And now how do you pay your creditors? And they need to pay their wages, their rent, their ongoing costs. So it may be pressure from creditors that you need the money for. Or it might be that you're wanting to invest in your business going forward it might be a slightly different shape of business to the one that you've got now. Or you might be just wanting to upscale and wanting to purchase equipment or working capital for a business that's moving forward, or again, the marketing of that new investment that you've made. So you may have pivoted, you may need equipment for that, and you may need to tell people that's what you're doing now. Or, so a lot of people, especially with the bounce back loan, have been using the bounce back loan to pay off more expensive finance. So if you already have a loan and you're paying, I don't know, maybe it's a funding circle loan or a business enterprise fund loan, and you're paying 12%, then getting a loan that you're not paying any repayments for 12 months and then only paying 2.5%, that's actually quite a good commercial decision to pay off expensive finance with much less expensive finance, freeing up cash for you to move your business forward. So what are you actually going to use the money for? So when you're thinking about what you need the money for, just bear in mind what financial institutions, banks, etc., don't like you to spend the money on. So if you're going for a loan or a finance product of any kind, and that particularly the high street banks find out that you owe HMRC a lot of money, they don't like it. They don't like you to owe money to HMRC, and there's a good reason why they don't like it. HMRC will take your legs out from under you in the blink of an eye. They will start wind-up proceedings on your business if you owe them taxes for a period of time. Now, I know that that's not really happening at the moment in the way that it was, but we have certainly had businesses who we've represented in the past who have had time to pay arrangements with HMRC, and overnight they've been making the payments, but overnight they've suddenly decided, no, that's not good enough, we want it all in now. And because HMRC are fickle, and because they don't really care about your business viability, they often outsource to people who just have targets to meet, then banks don't like you to owe money to HMRC because they just don't know what they're going to do next. So that's the first thing. If you owe money to HMRC, that can be a real red flag when it comes to looking for some kind of funding line. And the other one is payments to directors in the form of dividends. So banks like to think that if they're going out on a limb to help your business to survive, that you're in it with them. And if you're taking big chunks of dividend out of the business, then they don't feel like that's the spirit of you being in it with them and you know, saying, yes, you also believe it's viable. So often you should at the very least reduce the level of dividend if you're taking that out on a monthly basis in the form of a director's loan / dividend. Reduce that down to the bare bones as much as you possibly can, or just take a break from doing that if you possibly can. Banks, it can be a red flag, so just be aware of that. By all means, put together a cash flow projection that includes it in. If you've got somebody who you're talking to at a bank, if you've got a business bank manager, a growth enabler, they call them all sorts of different things at different banks. If you've got somebody who you're talking to, they should be able to say to you, do you know what, it ain't going to fly through our underwriting department with that on, or can we reduce it, or whatever. If it's an online application that you're making and that goes in, the computer could just say no. But just be aware that it might not be that anything else is wrong, it could just be because of that. So be aware of that. Okay, so the next thing is this viability. So we saw in one of the previous slides that on the Sybil's loans, there was an eligibility criteria that was that you had to have a viable business. Now, this is not new. Obviously, a bank, a financial institution is going to be looking for you to have a viable business. Otherwise, how are you going to be able to afford to make the repayments and pay their interest? And they are a commercial entity. At the end of the day, they need that money paying back. and all their interest paying. That's what they're looking for. So you need to be a viable business. But the change for the COVID related loans is that you needed to have business viability before COVID-19. So they're not going to be as concerned about your profit and loss account looking a bit poor since March, because everybody's profit and loss account, well, not everybody, but a big chunk of the UK's businesses' profit and loss accounts is looking a bit poor since March. That's not going to worry them. It's the trading history prior to COVID taking hold that they're going to be looking at. So when you do apply for a loan with a financial institution, typically they're going to be looking for last year's accounts as submitted to Companies House and this year's management accounts, plus that cash flow forecast that we talked about. So they're looking for how profitable you are. They're looking for a trading history of profitability and viability off the back of that. They're also often, it depends who you're getting the funds from, but most of the time they also want to see who you owe money to. So they're going to look for your age creditors and see who you owe money to and whether those people are likely to want to enact some winding up petition on you. So they're going to want to see that. So that's a normal thing. If you owe more money than it's looking like you're going to earn in the next reasonable period of time, then that could have a negative impact on the perceived viability of your business. So just have a look at that as well. And do you have a compelling story for how you're going to come out of this situation? So we're all in a very strange and never seen before situation with COVID-19 and the recession off the back of that. So that's the situation that we're in. But how are you going to come out of it? So there's lots of people talking about mindset and about how the people who are winners out of this situation and who will come out with a really strong business in a year's time are the people whose mindset is, right, how am I going to come out of this? What do I need to do? Not boo-hoo, the situation has really been poor and look what it's done to me. Yeah, it's done a lot of nasty things to a lot of people, but those people who've got a really strong positive mindset about looking at how to change, how to grow, and how to move forward from this will recover from it and will recover strongly. And the bank needs to see that. So you need to have a story for what your business is going to look like and how you're going to move forward out of this situation. So have a think about that as well. And then affordability. So after the crash, 10, 12 years ago now, and lots of people had been given funding that they couldn't afford to pay back. I know a lot of that was mortgages, but it affected the whole of the banking sector, and the whole of the loans landscape was affected by it. And out of it came a lot of new regulation and legislation that looked at affordability. So whatever it is that you're looking for now, whether it's car finance, whether it's a mortgage, or whether it's a business loan or any of the other business products, then the bank, the financial institution should be looking at affordability. Can you afford the repayments and the interest? And that they will make sure there is clear headroom. Because right now we have got the lowest interest rates that this country has ever seen. But how long will we have them? Well, we don't know. Again, we don't have a crystal ball. So the banks are saying, okay, so what happens if the interest rate went up to 3%, 5%? And if you're on a variable interest or so many points over base interest model, then can you still afford to make that repayment? So they're going to be looking for clear headroom, not, yes, I can afford it at a pinch, that leaves me with 27 pence in the bank at the end of every month. They're going to be looking for headroom, and they're going to be looking for stress testing on it, which is back to this scenario analysis. So what if that strategy that I'm looking to move forward with doesn't quite work out? What if I only get 90% of that? What happens if I get 200% of it? let's stress test it and make sure that there is a viable business that can afford to repay anything that it takes on. Right, we've talked about the specific loan products and grant products that have come onto the marketplace because of COVID-19. There was a landscape for loans and other funding options prior to COVID-19, and there will be one afterwards too. And the traditional funding options are loans, obviously. So traditional loans sit with, the top tier banks. The high street banks give the best rates, but they also have the highest hurdles, the most tick boxes that you need to get through to be able to get one. So there's those, and they will be looking for cash flow projections and all that kind of thing. But there are also, if you speak to a commercial lending broker, then they will be able to tell you all sorts of second and third tier lenders if those banks say no. And often it can be really viable businesses that they say no to. It's just that you don't fit the profile of what it is that they've said they're looking for. Typically, a lot of the financial institutions have not been interested in anything to do with construction. So not only construction, but things that are fed by construction. So it can be that you end up having to go to a second or third tier lender just because of the type of business you're in, not necessarily because of the level of profitability or anything like that. So there are lots of different financial institutions, but it's worth starting with whoever you bank with, or an amenable high street bank, because they do have the best rates typically available. Or, spend 500 quid with a commercial lending broker and just find out what's out there on the market. And they'll also guide you as to what level of information you need to provide, which is a really good service that they offer too. So if you've got an asset, so if you have got a manufacturing business and you've got some form of manufacturing kit, or you own a building and it's unencumbered, then you can go for asset finance, which is secured against that asset. So that's a slightly different product, and the banks quite like an asset to secure a loan against. So that works a treat if you've got things like that. Invoice financing and factoring are two very different things. I really like invoice financing and I really dislike factoring. So invoice financing is a product whereby you raise an invoice to a customer, you load it onto a portal with your finance provider, and then you can draw down a percentage of that the same day, the next day, whatever that might be. And often that can be up to 80% is a decent average, 80% of the value of that invoice. It then needs to be paid, but you chase it. So you keep the relationship and you chase the payment of that invoice. And if it hasn't been paid within often 60 or 90 days, then it will be clawed back out of your reserve of monies that you can draw down. So the bank are saying, yep, we can do this and we'll give you money off the basis of the fact that you've raised an invoice, but we do expect it to be paid in a reasonable amount of time. And that would all be written into the terms of the agreement that you'd got. But key, you keep the relationship with your customers. Factoring, they have a call centre who do the collection of your invoices. So they're on the phone to your customer saying that they want payment, and not always in a nice way. So you might have a really good relationship with your customers and you want to continue with a nice relationship with your customers. And if these factoring guys get in with their size 14 boots on and start upsetting your customers, you may no longer have that customer going forward. You may have your invoice paid, but you know that if you sweet talk them, they're going to pay anyway, or they always pay at the end of the month or whatever it might be. These guys are going to go in and do it their own way. And they also charge more for it. Because they're doing the collection, they have to fund a team of people on the phones doing that collection. So they'll charge extra for factoring for the privilege of upsetting your customers. So I'm not a big fan of that, and neither is really anybody who's ever used it, in my experience. Whereas invoice financing is a really good product in that it can grow with you. So if you're trading at a level of, let's say, I don't know, 250,000 turnover in a year, you then would be able to draw down 20 grand a month from what you're invoicing. If your business grows to 500,000, then the invoice financing facility grows with you. Whereas if you've taken a loan and it's for 50 grand, then it's for 50 grand. You would need to go back and get another loan if your need changes. With invoice financing, it flexes with you. As you grow, the facility grows with you, which is quite nice, in fairness. So it's worth looking at, definitely, but do be really particular about whether it's invoice financing or factoring. And then the other thing I just wanted to mention was overdrafts. So overdrafts was really commonplace and heavily used and liked in the industry before the crash. Lots of banks pulled the rug on overdrafts around that time and have tentatively come back into the marketplace since, but at a much lower level. Overdrafts are great because if you've got one, you can dip in and out of it when you need it and often only pay for it when you're using it. Well, that's fantastic if you can get the banks to give you one. And they are a little bit of a precious commodity, not that easy to get hold of these days. But if you need short-term cash just for a month in a year or once a quarter or whatever, they can be a really good product for that. So just a few bits on terminology. People get caught out with loan products sometimes because the quote that they're given, they'll say to me, oh, I've had a business enterprise fund loan and it's at 6%. And I'll say, oh, wow, that's a great rate. 6%. Is that the APR? And they're like, oh, I don't know. Anyway, it turns out it's the fixed rate. And the fixed rate means that you're going to pay 6% on whatever you loaned for the whole term of the loan. So if you've got a 2-year loan for £100,000, you're paying 6% in the last month of that 2 years in the same way as you were in the first month. Whereas an APR, you're going to be paying it on whatever you owe at that time. So in the last month, that's going to be significantly less than it was in the first month. Typically, a fixed rate versus an APR can end up being double. So if you're quoted 6% as a fixed rate, it can work out, if you compare it to an APR, you're paying twice the interest rate. So please look at the small print. Get your accountant to look at the small print and make sure that you understand what it is that you're actually signing up to. They must, by law, quote an APR on the documentation, but it isn't always as easy to see as the headline figure. So watch for that. Also watch for upfront fees. So setup fees, I've seen funding circle loans with setup fees as much as £3,000. And that, that's, if you spread that over how much you're loaning in the period of time, can really put the cost associated with that loan up. And they'll say to you, it's all right because we'll just add it to the loan. Oh yeah, that's all right then, because I still have to pay it. I've still got to pay that back. Oh yeah, thanks for that. But just be aware, because that might be the best product for you, but just look at all of these costs, factor them all in, and make sure that you understand fully the cost exposure that you've got for any of the products that you pick up. Secured will typically mean that it's against a something. So if it's secured, it'll be against an unencumbered property or a second mortgage on a property or against a piece of kit or your stock or something like that. Personal guarantee means that if your business goes under, that debt transfers to you and you still have to pay that. And they do, in certain circumstances, have the right to make you remortgage your house or sell your house or any other possessions that you may have. So if you are signing off a personal guarantee, then just be aware that that means that the debt transfers to you should anything untoward happen in the business. And joint and several, if you've got 2 or 3 directors, partners, shareholders in a business, and you're asked to sign personal guarantees, and you all sign personal guarantees, and let's say that personal guarantee was for, I don't know, 30 grand each. So you think, oh yeah, that's not too bad because it's 30 grand. Imagine now the business goes into liquidation, isn't able to afford to pay back, and that personal guarantee comes into place, and one of your co-directors goes bankrupt or isn't able, for whatever reason, they have nothing, they can't afford to pay their 30 grand, joint and several means that debt then transfers to you. They will go for whoever can afford to make that payment. That's what joint and several means. So it's just worth understanding some of these terms before you sign on the dotted on anything, just to make sure that you go into that agreement with your eyes wide open. And that is all I was going to talk about today. So I'll hand you over to James, and any questions?
Thanks, Joe. I hope you all enjoyed that. I've definitely taken away a few pointers from it, particularly at the beginning, talking to the local authority, on what potential grants are available, have that dialogue. But actually, towards the end, looking at more traditional lending methods, there is still options available via, the likes of Funding Circle and others. But just take into consideration the T's and C's. I also just picked up on the mindset, and I think that's really important, Joe. Particularly in this environment, something that's become quite a hot topic, I would say. One thing that one kind of thing I always try to do is, you start the day in whatever attitude, you choose your attitude for the day.
You do.
So, if you want to wake up in a grump, you start the day in a grump. But if you take a positive mindset, you generally, that goes through the day. Okay. I haven't seen anything on the chat function, but I think I'd like to open the floor to any questions that people might have around the subject. So you can either raise your hand or unmute and ask Joe directly. Does anyone have any questions that they want to ask? Joe,
Stunned silence.
Stunned silence. You've done a great job again. Okay, I think I'll kick it off just to kind of obviously, Joe. I think I've asked this before at one of your webinars, but obviously these webinars are only kind of catalysts for business owners to take away. What's the one thing that you would, if you were in an attendee's shoes, what's the one thing that you would take away from today?
I would say, first of all, do your homework to make sure that you understand what it is, how much you need, how long for, and what you're going to use it for before you speak to the bank. But then if they do say no, it doesn't mean you're a bad person or that you don't have a viable business. It just means that you don't fulfill the criteria that they have. There are lots of lenders out there. So if you, at first you don't succeed, try again. If you really do need funding and you've got a good reason to need that funding and a viable business, then prepare you do your own work, but then use that same homework. It's not like you need to do it again. Go out and try for the top tier funders and see if you can get the lower rates of interest. But if you can't, and you can afford there might be a slightly higher rate of interest for the likes Funding Circle, Business Enterprise Fund, or any of the other non-top tier lenders, then just keep trying, because it doesn't mean you're a bad person or it's a bad proposition. It just means you didn't tick their boxes. So don't be defeated at the first hurdle.
Thanks, Joe. Thanks. And there is, if you are a business in that situation and you have been maybe turned away from one or two, there is the support available from the Humber Growth Hub as well. I'd always be an advocate for speaking to them directly. Just to give you an update, we have a few webinars that we are have already planned. And I just wanted to kind of make you aware of. So we do have 2 events that we're delivering on behalf of the Humber for one Humber event, both on the 4th of June. Firstly, looking at new growth opportunities, talking a little bit about the pivoting that Joe mentioned today to find new profitable revenue streams. COVID-19 and beyond, business readiness, really building that resilience as a business, again, on the 4th of June. And then we're back with Joe on the 11th of June for Pricing for Profit. So we will, as I mentioned earlier, we are going to circulate the recordings for today and the presentations, but I'll also send links for each of these webinars that we're taking place in the future as well. So if you do have any questions, please feel free to get in touch with myself or Joe or anyone at the Humber Growth Hub. And yeah, best of luck, and perfect. Thank you. Thanks, Joe. If anyone does have any questions, we'll be online for the next 5 minutes. If you want to have a one-to-one chat, feel free to do so. Otherwise, we'll make it a close today.
Thank you, everyone.
Thank you. Joe, do you want to stop the recording?
I can indeed, yeah.